September is Life Insurance Awareness Month. And it's just a good topic to talk about because I think, in my experience, when I'm working with folks one-on-one, they think they know about life insurance. They think they have coverage, but they really, I would say 99% of the time they don't. It's unfortunate. So I hope in my presentation, I will be done at 7 p.m. Central. I just hope that you'll at least walk away with a little more knowledge and saying, okay, I understand, if you have coverage, great. I want you to fully understand what it is, but to also know that there's options out there. So I wanted to go through the ins and outs of life insurance, just basically beyond topics that, but beyond conversation pieces that we normally don't get. And for those of you joined on the Zoom, feel free to put any questions in the chat. You can also unmute yourself. I do want this to be engaging and try to answer as many questions as I can. So for those of you who don't know me, I think I know everyone here, at least in the Zoom. My name is Shantae Moore. I'm a certified financial educator and investment advisor representative, also a certified college consultant, which I need to do so much more work around, especially with FAFSA coming up on October 1st. Anyway, but overall, I teach people how money works. So I'm happy to have you all here to get this information. Now, a quick disclaimer before I get into the meat and potatoes of the presentation. You won't learn everything about life insurance on this webinar. I will give you some resources at the end to definitely follow through on, but is it going to go through every single thing? No, I'm going to highlight the top must knows about life insurance, but I designed it really for educational purposes. I'm not here to try and sell you anything. I mean, I am a life insurance agent. I can certainly help folks if I'm licensed in your state, but I really just wanted to educate you so that you could take this information and share it with others. And especially if you're watching the recording, some information might change. There are constant laws changing in the financial services industry. Not many with life insurance recently, I would say more so on the investment side, but just be cautious of that, especially if you're watching this recording like a couple years from now. So, if you connected with me in the past, one thing that I've always offered and shared was this book. If you can see my video, I'm holding up this book, How Money Works, Stop Being a Sucker. And I've been in this financial services industry for over 16 years. And I would say this book, in my opinion, is the best resource on personal finances, when it comes to educating people about the basics. And the first half of the book, it talks about just different financial concepts. Yeah, Gracie, she put in the chat, it's a great book. Actually, Gracie, if you're able, would you mind unmuting yourself and maybe sharing with the others what you like about the book? I know I did send it to you.
Yes, I love the book. It's very, very simple, really easy to follow. It's easy to just really pull out, extract different areas of information that you want to provide, right? So you don't have to go through the entire book to provide a presentation, but all the different areas of financial literacy and personal finance you will find in the book. And again, it's very simple. It's very self-explanatory, not only to extract that information for yourself, but also to turn around and teach it. So I absolutely love it. And it's for all of the information, it's just like, wow, it's a small book, right? But it's got a ton of information. So thank you, Shantae. I use it all the time. And like I said, I have it right here as a resource. So I love it. Thank you.
Oh, you're welcome. You're welcome. And if you want me to send you an extra copy, I'll be happy to do so. I'll drop one in the mail for you, especially if you share it with others, which I'm so happy to hear because it's so easy. So thank you for sharing that and promoting the book for me. It's been all over the place. It's a nationally recognized book. It's been on ABC, CNBC. So this isn't, first of all, I didn't write it. A lot of people think I wrote it. It's the company that I work with who wrote it. But this is a big deal. It's on Amazon. It's the number one selling book on personal finance since 2020. And it's the real deal. So I appreciate that, Gracie.
Yes, thank you. And thank you for providing your information on the little magnet, because I've had questions, who is she? So I've given your information to a few people. So,
Oh, thank you. Thank you.
yeah.
And appreciate that so much. But yeah, and the reason why I talk about the book is because the second half of the book talks about these 7 money milestones, which are, all right, now that we taught you and we educated you, how do you implement that education? How do you actually, apply that knowledge? And the 7 money milestones, and I won't go through all 7 because tonight I got a lot to go through and I'm limited on time, but the second milestone, is proper protection, and that's having proper life insurance in place. When we're talking about protecting against a potential loss of income or loss of savings, what if I'm no longer here? How will my family be able to carry on? So tonight's conversation, we'll talk about, making sure, how do we check that box off for milestone number 2? Now, quick thing, let's just get into the definition of what is life insurance. And there's so many definitions, but I just try to give a couple of different references. First of all, it's basically a contract with a life insurance company for your beneficiaries, to where if you pass away, they receive a lump sum amount of cash. And the cash goes to your beneficiaries completely tax-free. It's not reportable for taxes or anything like that. They basically have to submit a claim with the life insurance company. I like the website lifehappens.org, and this is their definition, basically saying if someone will suffer financially when you die, chances are you need life insurance because it provides cash to your family after death. This cash is known as the death benefit. It replaces your income and it can help your family meet many important financial needs like funeral costs, living expenses, college funding. And again, it mentions that there's no tax on the life insurance proceeds. And, I think, a lot of people forget the purpose of life insurance. They look at it as like another bill, and it can feel that way. It's, it's an expense to a degree, but I believe everyone absolutely needs it. And I wanted to just kind of take a step back to explain why. Why do I think you need to apply and purchase your own life insurance policy? Well, first of all, life insurance is not something that you can just get. Like, you can't just go shopping for it at a store or pull it off a shelf. Like, you actually have to apply for it with the many hundreds of life insurance companies, or, whichever one, and you have to qualify for it. Just because you apply doesn't mean you'll get approved. In some cases you can, but there's a lot of caveats to that. And I think when people finally get serious about life insurance and they're like, oh, I need it, they probably might be in a position in their life when they can't actually qualify for it. And unfortunately, I see that a lot. We'll talk a little bit about qualifications in a second. But also, I think this is probably the number one, myth that I want to bust around life insurance, is that a lot of people say, well, I got coverage at my job, Shantae. I have a life insurance policy. Why do I need to get my own policy? The reason is because your workplace might not provide enough coverage. First of all, and I'll show you how to calculate how much you need. We don't just pull a number out the sky. But what if you no longer work at that job? And we've seen a lot of people leave their workplaces. They left their jobs. If you leave, you no longer have coverage. So what does your family have to rely on? So I strongly encourage everyone, you need to have a life insurance policy that you own that is not tied to a job, meaning you purchased it, you pay for it. No matter who you're working for, you will always have coverage. But also for some folks who are younger, because a lot of people, I would say people think about these things, their finances in general, when they're like in their later 30s, when they have a family, a little, and older. Young people, if you have any young adults in your life, even juveniles, youth, minors, when you are young, especially if you're a young adult, typically you tend to have a lot of responsibilities, which therefore means you have responsibilities. They don't disappear if you're no longer here. You need life insurance coverage to take care of those responsibilities. A responsibility could be children. It could be a mortgage. It could be debts and, creditors that you owe money to. Those things don't disappear if you're no longer here. So life insurance is essentially to your beneficiaries receives that money from the insurance company so they can continue paying the mortgage. They can continue taking care of the children and so on and so forth. But also, while you are younger, you're generally healthier. And that is the optimal time where you want to apply and qualify for life insurance while you're still insurable, while the costs are still the lowest. Now, I'm not saying that if you're a little older, whatever your definition of older is, but obviously, when it comes to life insurance, the older you get, the costs do increase over time. But you want to make sure while you have no known diseases, while you're not on any medications, while you're not, sick and diagnosed with anything, that's the best time to lock in your life insurance health history or rating. And that way you can carry it into the future with any policy that you maintain. It ensures your family is able to continue without being financially devastated. How many folks did we see lose a loved one, in the last couple of years during this pandemic, and because of the C word that we've been living with for the last couple of years? And their families were financially devastated. They lost the breadwinner. Maybe they lost their home. Maybe they had to drastically change their life. I don't want to see that for anyone that I ever connect to. All your debts can be paid off. Again, those creditors do not disappear. They can go after your family and don't have some assets built up. They can make a claim to your estate and say, oh, wait, if Shantae has $100,000 in a 401k, I need to be paid first before you pay that money out to her beneficiaries. It can happen. A lot of folks don't know. I mean, most people, I would say, will a creditor find out you passed away? No. But if they do find out, they can make a claim to your any assets that you have left over. What about leaving money to fund your children's education or just to help them live? I believe, college is great, but will every child go to school? No. But if my children, my greatest fear is something happened to me while my kids are still young. My youngest is in second grade. I don't want my children's dreams or opportunities to be limited because I'm no longer here. So I have millions of dollars in coverage to make sure they'll be okay. But what about just creating a true legacy? Oftentimes I see folks, they have life insurance, but it's just enough to barely pay for the funeral. It's barely enough to just, take care of those final expenses. And maybe that's all they could afford. But if we do some proper planning, what about creating a true legacy? Like for me, I'm Native American, Indian, and African American. I have plans built to leave money to my tribe and to organizations that support my community because that's something I'm passionate about. I have other clients who they have in their plans to leave money to their church or a nonprofit organization, their favorite charity. Obviously, but also taking care of my family to where my kids, again, if something happens to me, they're instant millionaires. And that to me is a true legacy that I will gladly pay the monthly premium for every single year. So when we look at the statistics, only 59% of Americans actually have life insurance. And the ones that actually do have life insurance are underinsured, meaning they have a policy, they just don't have enough coverage. And I'll talk about how to calculate how much you need. So at least you can know, okay, do I have enough coverage? So yes, it is worth it. And you absolutely need the coverage now. So let's go into some education. I'll put my teacher hat on. I want to talk to you all about the two different types of life insurance because I want you to know what your options are out there and that so you can also be educated and having these conversations with others. First of all, there's only two types, only two. You have term life insurance or you have what we call permanent insurance, which would be whole life or universal life. I have my animations off a little different. Term is known as temporary insurance. Permanent insurance, the only type that you can purchase are whole life or universal life. That's it. Very basic, but let's break it down more. So when I explain term insurance to anyone, I tell them, think of it like you're renting an apartment. When you're renting an apartment, you typically sign for a term, a lease. Maybe it's a 12-month term, 6 months. And in that lease, you're paying the same amount for the length of that period of time, right? That you're living in the apartment. That's exactly how term insurance works. There you go. Check that off the box for you. Permanent insurance, on the other hand, is just like owning a house. When you own a home, it costs a little bit more, right? but you get something out of it. You get some value, you get some growth, some equity that grows with that asset. That's exactly how permanent insurance works as well. But I'm not going to leave you there. I'm going to go a little further. So with term life insurance, like I mentioned, it's for a set period of time. It could be a 1-year term, 5 years, 10 years. A lot of insurance companies that I work with go up to 30 years. Your costs are locked in for that period of time. And because you're only paying for coverage for a period of time, whether it's that 10, 30-year time frame, whatever it is, your costs are lower because the insurance company says, well, okay, we'll cover you for that time. We're going to lock it in. Your costs are lower. Now, what if that time period ends? It doesn't mean that your policy cancels. Actually, what happens is, let's say you had a 30-year term and then now it's about to expire. What happens is that the insurance company will renew that policy for another year and another year thereafter, each year thereafter. But what happens is they now adjust the cost to your age and whatever that day, whatever that time frame is later in life. So, for example, let's say I locked in a really low cost term insurance when I was 20 years old. And it was for 30 years. Now I'm 50. This 30-year policy is about to expire. The insurance company is now going to make me pay the cost of a 50-year-old woman for that same amount of coverage. So it will increase drastically. Let's say I was paying $15 a month. Now I might be paying $100 and something. And every year, if I keep the policy, the cost will go up. So it's not a bad thing, is it? Does that make sense? It really just depends on someone's situation. You can also just let the policy go at that time. You're like, okay, you know what? I had it for 30 years. I don't need it anymore. Let the policy coverage go. And you don't have to pay into it anymore. But you had really good coverage, during that time frame. So term insurance builds no equity. I get a question back a lot. Well, do I get money back after my term ends? No. Well, some companies, they have what's called a return of premium. None of the companies I work with offer that. But basically, it's like having car insurance. You have it for the coverage. Hope you never get into an accident. You basically hope you never die or anything. And, once the coverage is done, you had the coverage. You were just protected during that time. And that's not a bad thing. Some people have it in their mind like, oh, I don't get anything out of it. No, you have coverage. If something happened, your family would have received that death benefit. So 97% of the time, the coverage will end. Someone will either let the term, they'll let the policy, end, or they pass away and the death benefit actually pays out. But one thing I really, really like about term insurance that a lot of people don't really know is that they have, especially these newer term insurance policies by a lot of insurance companies, they're building in living benefits into their plans, which I'll talk about in a couple of slides. But basically what that means is if you became critically ill, chronically ill, or terminally ill, you become diagnosed with these major illnesses, or you had a major heart attack or a stroke or just something, major, you can actually access a portion of your death benefit while you are alive to help you recover, to help pay for those medical expenses. That's a living benefit. And again, a lot of insurance companies are building their term insurance with living benefits. So I love that feature in a lot of the insurance companies that I work with. And then the last thing is that term insurance, in most instances, you can actually convert it to a permanent plan. We mostly see this in the first 5 years of a term life insurance policy. And then once you're able to afford the permanent insurance, the insurance company will basically say, okay, great. We saw that you had this term insurance. You were approved. We're going to take your same health rating and apply it to a new permanent insurance policy. And then that way you can maintain a permanent policy first, moving forward. So I love term insurance. Does anyone have any questions about term insurance? Again, you can unmute yourself or put it into the chat. But great to have everyone. Let's go and talk about permanent insurance. So permanent insurance is a little different. Like I mentioned, it's like owning a home. So you have this for your entire lifetime. It's built to last you for your entire life. Most insurance companies will provide coverage through age 120. People are living well into their centennial years. So you can have this policy for a really long time. Just like owning a home versus renting, the costs are higher, and what that could look like, it could be 2, maybe 3 times the cost of term insurance. It really depends on everyone's situation. But your premiums, which are your payments that you pay every month, or you could do it every year, or you have a lot of flexibility in how you can actually pay into these policies. You can actually pay a fixed amount every month to month. That's actually for whole life insurance. Or you can have some flexibility when it comes to the different universal life insurance, where you could pay, you have like a range. There's a minimum, there's a maximum, you could do lump sum. There's a lot of flexibility. But I think one of the benefits that a lot of people like about permanent life insurance is that it builds cash value. Typically, they build cash value inside the policy. It builds equity, tax-free. Once that cash value is available, you can pull it out tax-free. It's actually a really great way to hide money. Like, not necessarily hide money, that sounds illegal, but like, it's a really great way to build money from a tax-free perspective legally. And you don't have to report it for like FAFSA. Like if your child is trying to qualify for financial aid, it can be used for collateral. It's a really good feature. And I'll talk about like what you can use with that cash value on the next slide. And with permanent coverage, it pays 100% of the time. As long as you paid into the policy appropriately, that coverage, if your family makes a claim, that money will pay out. Now, I've had some instances where some folks say, oh, my grandmother died and her life insurance policy didn't pay out. There was something that happened. Maybe she wasn't putting enough into it. Maybe her bank information got twisted or something. Life insurance companies don't deny claims for no reason. Trust me, they send plenty of notices if your policy is in trouble, if it might cancel out, if it might lapse. So if you have coverage, if you currently have life insurance, I highly recommend that you just review it with your life insurance agent. I'll be happy to look at that for you as well if you're not connected with them. Universal life insurance also has living benefits. In addition to like the critical, chronic, or terminal illness, those riders, they also have separate riders for long-term care, which I'll talk about in a second. So that's really it. You have a masterclass on life insurance. You know everything now. Really, that's really the basics of life insurance. So again, any questions, feel free to unmute yourself or put it into the chat. You might have life insurance. You might have one of these policies already. I do want to go a little bit more deeper into the 2 different types of permanent life insurance, because the differences are pretty, they can be pretty significant. Because a lot of times when I meet people, they say, oh, I want whole life insurance. I'm like, whole life? Like, why do you say that? It's just because it's so old school. That's what most people know about. I'm like, well, you mean a permanent life insurance? I just want them to understand that the whole life is only one type of life insurance. But anyway, let's talk about what whole life actually is. So basically, again, coverage for your entire lifetime, like I mentioned. Your premiums, which are the monthly cost, they're fixed every single month, every single year. However it was set up, you pay the same exact amount every time you make a payment. It's a fixed cost. It does not increase. Typically, life insurance companies, they average out your entire age and lifetime with all their actuarial tables, and then they average out the costs to insure you from your current age to age 100, whatever it is, and that's how they determine the cost for your whole life insurance. Now, there are other internal costs when it comes to having permanent life insurance. With whole life insurance companies, we don't know what they are. There's different expenses. It could be administrative fees. They just don't provide any clarity on what those internal costs can be. And, I'm not saying that's a bad thing or a good thing. I mean, just know it. And generally with whole life insurance, it will build some cash value by dividend payments. I've even heard I don't want to say it's new. There's actually a strategy called infinite banking where folks they'll basically add a rider to a whole life insurance policy. They basically pay for another separate death benefit, attach it to the whole life, and it just allows them to just stuff away and receive a lot of dividend payments. Whole life insurance companies' dividend payments are like a guaranteed 4% interest. That's a really unique strategy. But anyway, if you're just paying for regular whole life insurance, it will typically build some type of cash value. I would say for the most part, I wouldn't rely on that cash value to be like, oh, I can make major life moves with it later. I would just rather look at that cash value as something that can actually be used to help my life insurance costs later in life, because that policy, internally, it could get a little more expensive because, again, we don't know. But anyway, it can build some cash value life insurance. I would say if you have older generations, like baby boomers or older, they typically have whole life insurance because this is what was really popular when they were young adults and what they typically would have purchased at that time. Now, with universal life, there are actually 3 different types. You have your regular basic universal life, we call it UL. You have your variable universal life, which are VULs. And then you have your index universal life, which we call IUL. And what's really the difference? Universal life is basically, it's just like an upgraded version of whole life insurance, but it gives you a lot more opportunity to grow your cash value. It gives you that flexibility in how you can put money into it. Variable universal life is actually a life insurance that has their cash accumulation is invested in the stock market. So it's considered an investment. The person, if they sell you a VUL, they have to have what we call a securities license. And that cash value could go up and down because whatever, sub accounts they choose for the VUL does go up and down in value. And then you have index universal life. So full disclaimer, this is my favorite type of the UL, the universal life. Index universal life actually follows the stock market. It's not invested in the stock market. It just follows the stock market. It follows stock market indexes. So when the stock market indexes like the S&P 500, that's a very well known, it's kind of like the benchmark of how the US economy is doing. So that, for example, the IUL will look at and say, oh, what is this S&P index doing? Oh, the S&P index is up. So we're going to credit you, a percentage of that, into their account. The nice thing about IULs is that because it's not invested in the stock market, let's say the S&P goes negative, your account doesn't go negative. You always lock in the gains that you have. Talking about IULs is just a whole webinar in itself, and I actually did one last summer. If you want a link to that, let me know. I have it on my YouTube channel just about IULs. But anyway, so when we look at the whole universal life family, like I mentioned, the premiums are flexible. Your internal costs are transparent. So we can go to a life insurance company that sells any UL, VUL, IUL, and we'll be able to get a breakdown of what your premium goes. So let's say you put $200 into this policy, we'll be able to see exactly how that $200 is paid, for the internal cost that goes to the cash value. We'll be able to really see that transparently. That cash value, like I mentioned, you can really get some decent stock market-like growth. A lot of these, especially with the IUL, they have caps, so you can't lose anything. So you can get zero. They have a floor. But I've actually seen a lot of them go up to 20% interest that they can credit you if those indexes perform really well. They'll typically have a cap. I'm talking about IULs at this point. They'll have a cap on what you can earn. So, for example, let's say when the insurance company says, oh, we'll credit you up to 20% on the S&P 500 index. If the index does 13, you get 13. If the index does 23, you get 20. If the index goes negative 20, you get 0. So there's a floor, there's a minimum, and then there's a maximum. So there's a cap with how much you can grow. And the growth, it takes time. It really does take time. You're looking at probably 10 or 15 years. The money will not grow overnight. I have a lot of clients say, oh, well, I've had this policy for 5 years. I really don't see much cash value. I know it takes time. So that's definitely a long-term strategy. And then they do have living benefits, like I talked about, with having long-term care built into the plan. So let me go and talk about long-term. Oh, actually, let me talk about the cash value. Again, any questions, you can unmute yourself or put it into the chat. So what can that cash value do for you? Because this is a strategy that I do tend to recommend to a lot of my clients. I'm like, look, let's be very unique. It's not just about investing money in the stock market or in our 401ks or, on a phone app buying stocks. You can actually leverage life insurance as a strategy to build long-term cash for yourself. And what you can do with that cash is that once you're out of a surrender period, because those policies typically do have a period of time where they don't want you touching nothing. They want you to leave the money in there, let it grow. But once you're after that surrender period, again, it could be 10 years, 15 years, you could potentially have a couple $1,000s sitting in that policy. It really just depends on how much you're putting into it. You can pull that money out for anything. And that's what I really, really like about it. You can take that money out for buying a car, going on a vacation. You can use it for your retirement, to supplement your retirement. It's totally up to you. There's no requirements on what that money can be used for. So, here again, there's some advantages. You have that cash value. It grows tax-free. No creditor can make a claim to that. There's zero market risk. And again, I'm talking about the index universal life, the cash values inside of those. But you can also turn on, you can create tax-free income for yourself as well. So it's a really unique strategy that if you have the time and you properly this, you really need a strong cash flow and stable income to really fund this properly, because this type of strategy, it does not work if you're only putting in the minimum amount. It really doesn't. So like, for example, if your cost of insurance is like $50, you should really be putting in like $100 into this strategy. You want to be putting in way more than the minimum, way more than the cost of insurance. So let's talk about some of the living benefits. So when it comes to permanent plans, again, the IUL, VUL, UL, most insurance companies will also allow you the opportunity to add on a long-term care insurance benefit. Now, what does that mean? So if you can't perform 2 of the 6 daily living activities, which are, I always get this mixed up. It's eating, dressing yourself, transferring, like getting out of bed. What are the other 2 or 6? And I got a couple of my friends on here. Put it in the chat. What am I missing? The bathroom, and I don't know if it's cleaning yourself. I always get the 6, but you know what I mean. You need help taking care of yourself on a daily and regular basis. I hope my connection is okay. I'm not freezing up, guys. I just got to know about my internet connection. But anyway, if you need help with 2 of those 6 daily living activities, you can actually qualify for long-term care. And this is where in your life insurance policy, you basically will be able to qualify to receive a monthly payment. We can build it to be 2% or 3% of your death benefit. So let's say you bought $100,000 death benefit, you could receive $2,000 a month for up to 4 years to help pay for some of those long-term care expenses. It's a huge, huge benefit that can be added into a policy. And a lot of people have the misconception of thinking like, first of all, a couple misconceptions. They think long-term care is like just nursing home. Oh, if I'm a senior and I'm in a nursing home. No, if you can't feed yourself and get yourself dressed and get out of bed without help, you qualify. Another big misconception that people have with long-term care is they think that their health insurance from their job will cover it. And they don't. From my knowledge, I think it's the health insurance will only cover like the first 90 days of something. And then after that, you're on your own, or you might have to depend on the government to, step in and help with some of that stuff. So anyway, you want to make sure you have proper coverage. Also, another benefit, like I mentioned, for the term insurance is having a critical illness. So if you actually became ill or chronically ill, you access a portion of your death benefit while you're alive. And the difference, how much is that? It really just depends on the illness. It depends on the diagnosis. It also depends on how severe the heart attack was, or the stroke, or how bad the cancer is. And your doctor would have to indicate, the level of severity, the plan that they need. But anyway, the whole point is that if you got diagnosed with something crazy, you can actually get a lump sum amount from your life insurance policy to help with that. So it's a really, really unique benefit. So let's move on and talk about, which one should you apply for? Now, first of all, I always recommend sit with a knowledgeable life insurance agent. They should be explaining this to you. So again, hopefully you're learning and have the confidence to have the, speak with someone and get an idea. But, first of all, I won't say term is better than permanent or vice versa. It's totally not the case. You could actually even get a combination of the two. But I do have some general guidelines on which would probably be a better scenario in your current situation. The situation can change. For term insurance, I think it would work really great if you have a low budget, but you have a huge need. So I meet, for example, a lot of families where maybe there's a one income household, it's a single parent, they have multiple children. That's a huge need. It's really my house. I'm a mom, I have 3 kids. If something happens to me, how are my 3 kids going to maintain the life that they have? But maybe don't have the affordability of a permanent life insurance. Term insurance is perfect for that scenario because you can also get the maximum protection at the lowest cost. But also, it's a great way just to get coverage until you expect your income to increase. I think all of us have an opportunity for our financial situations to improve. Great. Let's get proper coverage now. And then later we can look at the permanent side. I also like coverage if you have really little ones, really minor young ones, young children. I say that's when you really need the most coverage possible is when you have these little ones who depend on you. Have a term insurance policy until they become adults. So like I mentioned, my youngest is in 2nd grade. He's 7. I have life insurance in place to where I think when he becomes a 30-year-old adult, and something happens to me, all kids will get some money and they'll be okay. Because I believe, every 18-year-old nowadays can live on their own without getting help. But anyway, some people do, and that's a blessing. If you have large debts, again, you don't want no creditors coming after your family or repossessing your car or taking, losing the home because you don't have coverage. Single people, this would actually be a good plan to have. Well, because some people say, oh, well, Shantae, I don't have kids. I don't have, people responsible for. Okay. Coverage, it doesn't mean that your situation can't change in the future. Let's get proper coverage now. We don't have to get millions of dollars. Let's get $100,000 policy. But also, if you just plan to eventually get a permanent policy, you're like, you know what? I like that cash value. Maybe it's not affordable for me right now, but let me get the term coverage so I can convert it, like I talked about. With permanent insurance, you have stable income and strong cash flow. Because again, like I mentioned, you want to be able to have enough money coming in to overfund this policy. You don't want to only just be minimally paying into the plan. So whatever that looks like for you, the last thing I want someone to call me up and say, Shantae, I can't afford whatever the premiums were, because I don't want you to lose that policy. I don't want you to waste that money. But also, again, cash value life insurance permanent can be used as another strategy to safely grow money long term. You can max out your retirement accounts at work, establish your IRAs. Let's look at this strategy as well. It's a really good strategy to where you can, again, safely grow money. You don't have to take on those losses, especially, again, like I mentioned, if you use the index universal life. Tax-free bucket of savings. You can leave a legacy, and then you can have those living benefits built into the plan as well. So how much do we need? Because a lot of times, and then you get peace of mind. Whatever, have coverage, so you got peace of mind. If I have time, I'll tell you guys a funny story at the end. So how much coverage do we need? Because now that you know about life insurance, maybe you're saying I need term or permanent, or maybe a combination of the two. Well, how much is enough? I talked about being underinsured, right? So a general rule of thumb is that you need 10 times your annual family income in coverage. So in this first example, if you make $50,000 a year, you need to have $500,000 in coverage. And as you can see, the more money you make, the more you should have. And you're like, why do I need 10 times my income? Well, if your income is significant to your household, again, you have to imagine you're no longer here. You're not bringing in that income there. Your household is used to living off that income. Let's at least replace it for 10 years so they can still pay the bills. They can still pay the mortgage. They can still live the life that you built for them. Another way that you can calculate how much life insurance you need is a method that we use called the DIME method. D stands for debt, I is for income, M is for mortgage, and E is for education. So, and I like this because it's a little more detailed, but basically what you do is you calculate different different to be paid off. Credit cards, would you like all that debt to be paid off? Great. How much is that? Let's write that number down. Income. We already talked about 10 times your annual income. Let's add that number in. Mortgage. Mr. and Mrs. Client, if something happened to one of you, would you like your mortgage to be paid off? Would you like to maintain the home, or do you want to just sell it? And I'll tell you real quickly. A lot of people say, "Oh, well, I have mortgage insurance." That mortgage insurance is for the mortgage company. It's not for you. It's for if you default on that loan, they're protected. The money doesn't go to your family. So, want to just throw that in real quickly. And then E is for education. This is really a open-ended bucket. But if you have kids, if you want to save money for them to go to college or start a business in life, or just to get a head start, you can or if you don't have kids, again, leaving a legacy for, your favorite charity, your tribal organization, whoever, your church, your religious organization, you can allocate and calculate into your life insurance how much you would like to leave behind. So in this example, we have a husband who makes $40,000 a year. The wife makes a little more, $60,000. Both of their insurable needs are about $1 million. When you see the calculation, like, okay, all my debts will be paid off. Family will be able to live off income for the next 10 years. The mortgage will be paid off and our kids will be okay. It makes sense. And unfortunately, a lot of people just don't have proper coverage. They might have some coverage, they just don't have enough. So that's a method that my associates, my team, that we use when we sit down with families to calculate what they need. All right, so I want to get done in the next 10, 15 minutes. So how do you qualify for life insurance? Because remember, I said you have to apply and qualify. Now, some life insurance companies will, especially the ones who advertise a lot or in the mail. I see a lot of credit unions who will randomly send mailings and say, "Oh, we'll get you life insurance as guaranteed coverage." Let's look at what that actually is. Number one, it's term insurance. It's almost always term insurance. And it's normally a 1 year or 5 year term insurance. And then every year the costs will go up. Hundreds of thousands of dollars on that type of policy. A policy that'll give you the proper coverage. You want to go through what's called an underwriting process when we're looking at, look at your application. And about that in a little second. But what do insurance companies look at when they're looking at an application to say, okay, do we approve this person or not? Because at the end of the day, you have to remember, this is a contract. So the insurance company, if you pass away, they have to be able to write that check to your family for that $500,000 or whatever it is. And so they have to measure the risk it is to insure you. They look at your age. Again, the younger you are, the healthier you are. That's a good thing. I would say most life insurance companies will offer coverage up until about 80, 85. Before they say, no, you're too old to cover. So again, if you're in your 50s or 60s, you're fine. You can still get coverage. They look at your height and weight. They call it your build. So if you're really, really small, but you're, a little overweight, that could actually, unfortunately, count against you. I've had a couple clients who are declined just on build alone. And it's not for me to say healthy was not healthy, was overweight or underweight. Insurance companies, they have their own numbers to determine what's riskier to them. They'll definitely ask about any past and present health issues. So they will ask, who's your doctor? When's the last time you've seen them? What diagnoses do you have? Are you on any prescriptions? What is that prescription for? The worst, I would say the worst, sometimes they'll pull your medical records. So in an insurance application, you will sign a HIPAA authorization form so that they can get access to that information. I always tell clients, look, don't worry if you have medical issues. Just let me know, because most insurance companies, it's not a major issue. All they want to know is that you're seeing your doctor, you're doing what your doctor tells you, you're on your prescription, you're getting your test results. That's all the insurance companies want to see that you're taking care of yourself. You can have diabetes, you can have, heart issues. As long as you're following your doctor's orders, it doesn't mean that you won't be able to qualify for life insurance. Now, if you have a diagnosis and you didn't get the follow-up test that they told you, you're not taking your prescription, that's when insurance companies have an issue and they'll have a problem with that. But anyways, most people are taking care of themselves. And then the insurance companies will be able to determine is everything under control. That's all they really want to look for. I'll tell you matters. Right. You will get covered, but you'll probably pay about 2 times the cost of a non-tobacco user. Some insurance applications will ask about your family history, especially if someone passed away really early. Why, if somebody passed in their 50s, like why did, this person pass away? Or if there's a history of cancer in the family, or if there's a history, that's just something that they'll probably look into. It doesn't mean that they'll not approve you. They'll just look into it further. Your driving record. Life insurance companies do not like DUIs. They do not like you having a driving under the influence infraction on your record. I don't care how young you are, how healthy you are. I would say if you had a DUI within the last 12 months, automatic decline. Some life insurance companies don't want to see a DUI in the last 2 years. It really just depends, but DUIs, they do not like that. They look at it as, unfortunately, just a reckless lifestyle. Same with having a criminal record. First, I get this question once, so I'll answer it. If I'm in jail or if my loved one's currently incarcerated, can they get coverage? No, decline. If you have a misdemeanor or felonies and it's 5-10 years old, that's okay. Insurance companies are looking around, okay. We just have to explain, we have to disclose that information. And then here, put high risk activities. So what does that mean? If you like flying airplanes or jumping out of airplanes or scuba diving or mountain climbing or racing race cars, high risk activities, the insurance companies, they'll be like, okay, hold on, let's evaluate this. Because again, they're trying to measure the risk to them to actually provide any type of coverage for you. So those are some general questions that you can expect to see on a life insurance application. So let's talk about the actual process of the application process. So you know how much coverage you need, you know what type of plan you want, you know what company you want to work with. What does that process look like? First of all, find a knowledgeable and unbiased insurance agent. I had to put the word unbiased because unfortunately there's so many insurance agents where they're so laser focused on, it's only got to be term, or it only has to be whole life, or, they're just so focused on trying to put a square peg in a circle. Don't work with them. You want to have someone who gives you options. They explain to you what's available, what you can qualify for. Just like I explained today, you really want someone who can really share with you what's available. They're not just trying to sell one particular product. That's something I've really cautioned you to worry about. This person, an insurance agent, they should really look at your whole financial situation. Like I talked about with my organization I work with, we use the 7 money milestones, and I look at every area of someone's finances to help me determine what level of life insurance they need. I also encourage you to get 2 or 3 life insurance quotes or illustrations from different insurance companies. They have, most policies work the way that I kind of described it, but some of them have different bells and whistles, different benefits. You want to just kind of shop around a little. I at least present 2 options to anyone that I work with, just so they can compare and make an informed decision. And beneficiaries matter. When you are putting in an application, you do have to name a beneficiary. I could spend 10 minutes just talking about beneficiaries, but real quickly, whoever you list as a beneficiary, if something happens to you, they get that money, a check made out to them, and they can do whatever they want with that money. They don't have to take care of your kids. They don't have to pay off your debts. Like, yes, that was your intentions, but they don't have to. So you want to be very cautious of who you name as a beneficiary, or establish a trust, and the trust will take care of all of that. So beneficiaries do matter. Oh, last thing I'll say about beneficiaries is do not name a minor child, anyone under the age of 18 as a beneficiary, because they will not be able to get that money until they become an adult, or else your family will have to go through the courts. It's a very complicated process. Only name adults, please, as beneficiaries, and check them every year. Unfortunately, I had a client whose father just passed away, and their father actually had a deceased beneficiary. He updated it years ago. It was never updated. He passed away. And now, unfortunately, the family is going to have to make a claim to his estate to get that money that could have easily went to someone. So it happens. It really does. So now we submit the application. Most of these are done electronically, thank God. So an insurance agent will collect that information, type it to the electronic application, and send it to you to email, and you can electronically sign for it. Typically, you can submit the first month's premium with the application. That'll give you what we call conditional coverage, meaning, if let's say, God forbid, something happened to you while you were in the underwriting process, and you would have been approved. You did the blood work. You did everything that they needed, and you ultimately would have been approved. Your family will receive that death benefit just because you submitted that first month's premium. We call it a conditional receipt. There's conditions to meet to receive that, but you don't have to. Most insurance companies, you can apply without submitting the premium just to make sure you get approved. It really just depends on what works for you. But when you're submitting an application to the insurance company, they'll do a review. They'll probably do a quick check of your medical history. They might come back with questions. They might say, hey, Shantae, you mentioned that you like jumping out of airplanes. Tell us a little bit more about that. Or we saw a history of this. Tell us more. Or again, they might order records from your doctors. Whatever the case is, just respond. Let your agent will come and tell you. Get back to your agent as quick as possible with that information, so that the insurance company can move through the process. Sometimes, I would say most times, there might be some type of questionnaire or an interview that you might have to complete. Some insurance companies will even ask you to complete what's called a paramedic exam. And that's basically where they'll send a paramedical examiner to come out and collect blood and urine from you. So I always tell folks, be very honest on the applications. You can lie to me all you want. I mean, I hope you don't. But if I'm the agent submitting it and you're telling me I don't have any major issues, I hope that's the case, because the insurance companies will find out about it. Trust me, they will find out. So once they get all the information, underwriting can be short or it can be long. It can be as quick as a week. Some companies can take 8 weeks. It can be even longer. We've seen, just in general, because of COVID, life insurance companies are looking into everything. They're questioning everything. I had a client who just got approved last Thursday. We submitted her application, I want to say back in June. 3 months, over 3 months. Mine actually been a little bit longer. And if they make a decision, they'll either approve your application. As you apply, they'll approve it. They might say, you know what, we'll approve it, but we're going to make some changes. And then you would have the opportunity to accept that offer with those changes, or you'll just get a flat decline on the application itself. So hopefully you get approved. Again, it's not. And I would say, even if you get declined, maybe you were declined on one, variable for that particular life insurance company. At least once we know that the reason, I could then look at other life insurance companies who are lenient in that area. So don't think just because you got declined that all hope is off the table. I work with over 100 companies. So me personally, I keep looking around until we exhaust all of our options. But lastly, pay all your premiums. Once you have this policy in place, now you're just going to be making your premium payments, make them on time. And always check in with your life insurance agent to review the policy at least once a year, just to make sure nothing's changed. I mean, your life might change. You might need more coverage. We might need to update beneficiaries, the address. Just have a quick 15-minute conversation with your agent at least once a year to make sure that everything is all good. Okay, guys, I'm done. If you have any questions, feel free to unmute, put it in the chat. I'm happy you guys stuck out with me this long. For those of you who joined through my invitation, I'm a licensed lecturer agent so I can have these conversations. Hopefully, I'm licensed in your state. But if you would like to just talk to me further about life insurance, I mean, I can look at your whole financial situation, but really anything that I talked about, maybe you might have a life insurance policy that you would like for me to review for you. I'll be happy to do so. You can actually schedule a 30-minute Zoom consultation with me at bit.ly/talk to Shantae. If you're connected to me, you're probably receiving my newsletter. If you're not, you can email me at shantae.moore@howmoneyworks.com. I'm happy to say that I send out invitations to events like this, blog articles. I'm constantly sharing out resources. And then connect with me on social media. Follow me, like my Facebook page at Shantae W. Moore. Follow me on Instagram at Shantae W. Moore. And please subscribe to my YouTube channel. You can search Shantae Moore, Certified Financial Educator. And all my presentations that I host and record, I upload them to YouTube so that you can always go back.